At 3 o'clock in the afternoon in London, 5 men sat on a secure conference call. No cameras, no public broadcast, and no outside record recorded their private voices. With a few spoken words and millions of ounces shifted on a private balance sheet, the global benchmark price of gold was reset. It looked like routine price discovery, but the numbers moving across trading screens revealed a cold, calculated pattern. For decades, the London Gold Fix was portrayed as the gold standard of financial transparency. 5 major bullion banks met twice daily to match buy and sell orders for physical bullion. But beneath this quiet corporate ritual lay an unchecked mechanism of absolute market power. The participants were not neutral brokers executing trades for global clients. They were trading on their own proprietary accounts at the exact same moment. Trade logs from the late 1990s through 2014 reveal a structural anomaly that occurred with mathematical precision. Minutes before the official fix was published, massive sell orders flooded the exchange. These artificial dumps lowered spot market prices just enough to trigger stop-loss orders from independent investors. The presiding banks then bought up those discounted assets, securing guaranteed profits before the official benchmark was even announced to the public. This systematic price suppression was not an accident or a technical glitch in trading software. The underlying incentives of modern financial markets demanded an anchored gold valuation. Gold acts as the ultimate barometer of monetary health. When gold prices skyrocket, public trust in paper money and central bank policy crumbles. By controlling the daily benchmark, elite financial institutions protected the perceived stability of global currency systems. To execute this manipulation at scale, the financial architecture relied on a severe divergence between physical commodities and paper claims. On one side sat physical bullion, vaulted in heavy concrete chambers beneath city streets. On the other side sat paper gold, an endless ocean of unallocated derivatives, swap contracts, and futures promises. The paper market allowed major traders to sell claims for metal that did not exist. In a true physical market, selling thousands of tons of metal requires physical delivery, heavy transport logistics, and strict assay verification. In the paper derivatives market, a trader simply enters a keystroke to dump 100 tons of virtual supply onto order books in seconds. This artificial flood creates the illusion of a massive market surplus, dragging spot prices down regardless of real physical demand. When paper derivatives dwarf physical reserves, the fundamental laws of supply and demand are inverted across global markets. Mining operations extracting raw metal under dangerous subterranean conditions found their operational margins crushed by synthetic paper dumps engineered in financial capitals. Sovereign treasuries holding physical bullion saw the real purchasing power of their reserves revalued by a private cartel of 5 global banks. The structural illusion relied heavily on the widespread use of unallocated gold accounts across the banking system. When an investor buys unallocated gold from a major bullion bank, they do not hold legal title to a specific stamped bar. Instead, they hold an unsecured claim against the balance sheet of the institution. The bank operates on a fractional reserve system, issuing dozens of paper claims against one bar. Internal bank records later scrutinized by international regulators showed fractional reserve ratios stretching far beyond prudent risk boundaries. For every single ounce of physical bullion sitting in London vaults, there were up to 100 paper claims circulating through global clearing networks. This immense paper leverage allowed bullion banks to absorb runaway buying pressure during economic panics, neutralizing physical demand with infinite paper supply.
During the global financial collapse of 2008, as equity markets crumbled, public demand for physical metal reached unprecedented levels. Mint facilities ran completely out of gold coins, and physical premiums soared worldwide. Yet paper market quotes driven by the London Fix recorded sharp price declines. The widening divergence between physical scarcity and synthetic paper quotes exposed the structural rigging built inside the financial machine. The mechanics of this suppression operated through high-frequency algorithmic trade strategies known as spoofing. Traders placed massive sell orders for gold futures contracts without any intention of allowing them to execute. These phantom orders flooded electronic order books, signaling fake market weakness to automated trading algorithms. As algorithms panicked and sold off positions, traders canceled their initial sell orders and bought up cheap assets.
This synthetic price cap provided immense geopolitical utility for central banks and monetary managers. A rapid surge in gold prices exposes systemic inflation and erodes global confidence in major reserve currencies. By keeping gold prices controlled through derivative market expansion, monetary authorities maintained low borrowing costs and preserved international trust in fiat paper assets. Paper derivatives served as a hidden line of defense for central banks. By 2014, statistical evidence documenting the London gold fix became too flagrant for international authorities to ignore. Academic studies analyzing trade logs over a decade demonstrated a persistent, non-random drop in gold prices right during the fix window. Regulators in Germany and Switzerland launched formal investigations into participating bullion banks, uncovering private chat rooms where institutional traders explicitly coordinated quote submissions. Transcripts exposed in regulatory enforcement actions revealed institutional traders bragging about moving benchmark prices to trigger massive payouts on complex options contracts. A shift of just a few cents in the final fix meant tens of millions of dollars in net gains for trading desks. What was sold to the world as a trustworthy global benchmark was operating as a private revenue engine for insiders.
Faced with historic financial penalties and public exposure, the century-old gold fix teleconference was formally dismantled in late 2014. The manual fixing call was replaced by an electronic auction platform managed by third-party administrators. Yet changing the software platform running the benchmark did not resolve the underlying structural defect of a fractional reserve paper market dominating physical commodities. The structural imbalance between physical bullion and paper derivatives remains active within the global monetary system today. The overwhelming majority of international gold volume still moves through unallocated paper contracts on derivative exchanges. Because synthetic paper volume can be expanded infinitely through bank credit while physical gold remains strictly constrained by nature, paper derivatives continue to dictate spot price discovery. In response to this ongoing market distortion, central banks and sovereign investors across Eastern Europe and Asia began withdrawing physical bullion from Western vaults. National treasuries shifted away from paper certificates, demanding physical delivery of heavy gold bars back to their domestic balance sheets. Thousands of metric tons of physical metal moved out of London vaults, quietly weakening Western paper leverage over global commodities. This accelerated drain on physical reserves threatens the underlying stability of fractional reserve commodity trading. If a critical mass of paper claim holders demands physical delivery simultaneously, unallocated derivative systems face an absolute liquidity wall. When physical inventories fall below clearing thresholds, Paper futures can no longer guarantee physical settlement, threatening a sudden reset of global pricing models. For ordinary citizens attempting to preserve purchasing power against currency debasement, the manipulation of commodity benchmarks creates severe distortion. While central banks expand fiat money supplies, synthetic paper dilution holds down the market value of hard assets. The artificial suppression of physical commodity prices masks underlying monetary inflation, blinding everyday investors to the true rate of currency depreciation. Even after regulatory enforcement actions yielded billions of dollars in fines against major financial institutions, algorithmic order manipulation continues to surface in federal court filings. Modern market analysis shows that high-frequency algorithms have simply replaced manual manipulation techniques. The speed of execution has accelerated to microseconds, but the fundamental strategy of controlling price discovery through phantom liquidity remains unchanged. The history of the London Fix illustrates how private banking syndicates can capture the essential mechanisms of global price discovery. By inserting an ocean of unallocated paper derivatives between physical supply and human demand, financial institutions constructed an artificial market reality. The paper quote became the accepted truth across world media, while physical scarcity was completely suppressed beneath synthetic leverage. As long as paper claims exceed physical reserves, true price discovery in global commodities will remain compromised by structural design. The London Fix was never merely an isolated trading scandal. It was a clear demonstration of how derivative markets can override physical reality. But while paper contracts can suppress real commodity prices for decades, physical supply ultimately dictates the final settlement of economic history.